Hi, everyone. I'm Carol Masser from Bloomberg Businessweek TV and radio. Welcome to day 3 of the Bloomberg Businessweek. It's a week-long event. We're bringing the magazine to life and offering a window into the journey as we go to press. Well, today's programming, it is focused on one of the verticals of the magazine, finance and economics. Democratization of investing has transformed the markets with Bitcoin, SPACs, and the Robinhood effect all emerging as new trends in investing. Today, we're going to be covering those topics and more. We've got a great lineup. Alex Rodriguez, Cathie Wood, Binance US CEO Brian Brooks, and Atlanta Fed President Raphael Bostic. Perfect lineup for all that's going on in the markets right now. Before we get started, we do have a few housekeeping announcements. First of all, I'd like to acknowledge our solution sponsor, Deloitte, our presenting sponsor, InterSystems, and of course, our supporting sponsor, Indiana Economic Development Corporation. Now, a little housekeeping. If you experience any issues with audio or video quality, try to refresh your browser or use the chat box in the bottom right corner of your screen for support. You'll also be able to submit questions during the interviews, and while we're probably not going to get to all of you, we certainly are going to try our best. To submit a question, do open the white tab on the right-hand side of the video window, submit your question, and if you note your name and geographical location, we're going to try and give you a shout out as well. Please definitely engage with us on social media using hashtag #TheBusinessWeek, and also engage with other attendees in the event chat in the bottom right corner of your screen. So, got a lot going on today, so let's get started. Please join me in welcoming our first guest today, Alex Rodriguez, Chairman and CEO of A-Rod Corporation, in conversation with Bloomberg Quick Takes, Jason Kelly.
Well, Alex, it's really nice to see you. Thanks so much for spending some time. It's an incredibly busy time for you from a deal-making perspective. We're going to get into all of that in a few minutes, but I want to start sort of at the beginning if we can, because this business that you are building is much more than, you know, a former athlete's kind of side hustles. This is the hustle in many ways. This is a massive growing series of businesses. But take me back to the inspiration for it and why you take this so seriously in terms of really building this series of businesses.
Yeah, thank you, Jason. For me, I think it starts with my mom, just watching her every single day, having 2 jobs. We come from very humble beginnings. My father left when I was 10, and we were left with my mom and my 2 siblings, my brother Joe and my sister Susie. And I've always had this entrepreneur spirit of the 2 Bs. I wanted to have baseball and be a CEO in business. And that started when I was about 10 years old. I saw my mom work 2 jobs. I saw her really struggle. I saw that the lack of financial literacy knowledge worked against us. So that's something that I'm really, really passionate about now. And I also remember my mom coming home on Thursdays and Friday nights with her tip money from serving tables at night. And as a 10-year-old boy, I would have to lift the mattress to help her. And she would take that envelope and just throw it under there. And the reason why, Jason, was because we didn't trust banks, as she told me. She trusted her mattress. And that was the mentality that I grew up with. So that gave me the inspiration that I didn't want to be renting apartments for the rest of my life. We kept moving every 18 months because the landlord kept raising the rents. What I kind of dreamt as a kid and hoped for and prayed for was that one day I can trade places with a landlord. And sure enough, about 12 or 13 years later, I had my first opportunity to buy a duplex for about $250,000 with a $48,000 down payment. And I did that, and off I went with my business career.
Wow. And so that I want to stay with that for a second if we could, because real estate really, it feels like, and the whole concept of ownership even more broadly, I mean, that does sit at the center of all this, right?
Yeah, and as you know, one of my great mentors, Mr. Warren Buffett, he always taught me, stay in your circle of competence. And just by default, Jason, just by being a lifetime renter with my mom, I understood that every month, you know, rain or shine, we had to pay our rent. And that created a consistency and a framework that I thought, boy, if I can start buying real estate when I'm really young, get some moderate debt, as I pay down my debt is a perfect hedge to my professional career, because as I make W-2 income in my 20s, I can buy assets that generate some cash flow. And as my career winds down, my real estate appreciates, my cash flow appreciates and increases. And I thought that was a great hedge, simply not to go bankrupt like you read about a lot of athletes and entertainers post their careers.
So let's talk about that transition, because it's a fascinating one for you. And as I alluded to earlier, there is a very successful model out there that basically says you play ball, you do well, you build a portfolio that is largely based on endorsements more than anything. But, one of the people that I believe you consulted early on was Magic Johnson. He obviously has set a different sort of standard. Tell me about that and what you took from your friendship and interaction with him.
Yeah, first of all, Magic is a friend and a mentor and one of my heroes. Magic is he's been such an inspiration for me. Jace, we went to a dinner because I asked him for some help and guidance. And this was when I was almost 20 years ago when I signed with the Texas Rangers. And I asked Magic for some advice. He took me to a steak dinner in LA. I thought it was going to be like 30 minutes. It was like 3.5 hours. And he basically laid out the entire playbook. And I could not believe how generous and humble he was, how his advice and experiences, both the good and the bad, has been a pivotal part of how I build out A-Rod Corp. And to this day, we talk about that. But the point is, I think if you're a mentee, there's plenty of great mentors out there that are willing to share experiences, and it's priceless and invaluable of how much value it can bring to folks like me. And now I'm doing it for, dozens of athletes and entertainers who call for advice, and is my opportunity to pay it forward to what Magic and others did for me.
All right, so take me inside the portfolio. Help me understand, some of the more representative investments inside A-Rod Corp, because anybody who spends some time on the website, you see it is wide ranging, and yet there are some clear themes. You are going deep on a couple different themes. Tell me about one or two of those.
Yeah, I think, A-Rod Corp does two main things. One is we have a legacy real estate business that goes back about 20 years. And then we do venture and private equity deals, and we're taking minority and sometimes majority positions in companies. And we own over 30 companies in our portfolio. We're taking about 7 or 8 public here this year. So it's been an extraordinary year for ARC. But think about a company like Hims & Hers that we came in a few years ago. It just went public earlier this year, and it's been a great success. Telemedicine for the masses at an affordable price. We like the space. It has a huge TAM. And when you think about a business that throws off 92% reoccurring income with 76% margins, we think that's in the early stages of what could be a really great company. That's one. And then you take one that I did with Mark Laurie called Archer, Flying Cars. We came in around $125 million valuation, and we took it public at $3.6 billion. And Mark did this all within 2 years. So it's wide ranging, but it's really a place where we can bring value and really bring in the capital and the people.
All right, so you brought up Mark's name. Let's talk about some of your partners and sort of how you make this approach, because one of the things that's clear is you're picking partners in different regards and for different reasons. Let's talk a little bit about Mark, because he comes into play for a venture capital firm that you're starting, but also more notably, and right now, comes into play as a fellow potential owner in an NBA team. I know that is still ongoing, but reports are that the Timberwolves, you have an agreement to buy it. We'll leave the details to be worked out, but tell me why you want to own a team.
Well, I think, look, we learned a lot through the Mets process. We worked really hard on that. Like I tell my friends, we were the second winners. It was an incredible process that we learned a great deal. What we learned is that these are more than just sports teams. They're media entertainment platforms that is their intersection between e-commerce, technology, media, sports, and entertainment. And when you look at the NBA and you look at the tailwinds, you look at the leadership, you look at the global footprint and where it's going, the young demographics, the eyeballs, they get entertainment as well as any league in the world. And Mark and I are close friends, we're partners, and we think that our set of skills combined can be a great added value to a sports franchise. So we're very excited about the opportunity.
So tell me about that. Tell me about that relationship and how something like that develops in terms of figuring out how the skills mesh together. I mean, clearly, going through the Mets process, as you say, taught you about what you guys could both bring to the table, but you're also starting a venture capital firm with Mark. So how does it work?
Yeah, look, Jason, a lot of what I do in business, I frame it back to my Yankee days, right? And I think complementary set of skills work really well. You can't have 10 shortstops, right? You can't have 10 pitchers. So the idea is, Derek Jeter and myself are great complements to Mariano Rivera and Andy Pettitte. And you put the four of us together, that makes a championship, combination. When you look at Mark Laurie and I, we're great partners because we have complementary set of skills. He's world class when it comes to e-commerce, technology, computer. I barely know how to turn on a computer, so we make a dream team. I bring my 25 years experience of professional baseball, business, but we really complement each other. Number one, we're great friends. Number two, there's infinite trust there. And those are the two things, foundation, that you need in a partnership in business that can last for years and years.
So tell me about this venture capital firm, because the whole notion of it, Vision Capital People, VCP, what's the business model there that maybe differentiates it or distinguishes it from some of the other pools of capital?
Yeah, great question, Jace. I think for us is VCP stands for Vision Capital People. The first time I understood what that VCP meant to me was when George Steinbrenner brought me to the Yankees in 2004. I sat down with him and he described VCP better than anyone. He said to me, Alex, we have the vision that we want to be the best franchise in sports around the world. And we have a clear vision of that. He says, we have tremendous resources on the capital side. We're going to deploy more capital than anybody else, and we're not going to take any shortcuts. And then we're going to go out and find the best people in the world. We're going to pay them the best, and that's going to keep us at the top forever. So when I sat down with Mark years later, that's exactly was his vision. And we went out and executed that. We've taken about 6 or 7 companies that we've acquired together or incubated. And then we thought about, why not just make this into a fund and bring our friends and families into this ride with us.
And so ultimately, is this is a pool that could take outside capital? Like, how does that part of the business grow?
Yeah, so the idea is to take a big stake in companies, anything from anywhere from 40% to 80%, where we're controlling the business. We're putting $10 million pre-seed. We did this with NowWith, for example, is a company that we're very excited about, social media and e-commerce. And we're launching here in June. We put in $10 million pre-A, and then we'll go out in the second round, maybe Series A, put another $50 million to work and really help determine the outcome of that business through the vision, through putting great capital to work, and then finding people to surround our founders with, where we can take a company that's good to great.
So when we think back across the last year or so, in addition to all becoming, amateur epidemiologists, we also became very familiar with the whole concept of a special purpose acquisition company, a SPAC. You're involved with one. It has gone public, Slam Corp, I believe it is called. Tell me about how that fits in. That is not the vehicle, we should be clear, through which you're pursuing buying sports teams. But what has been your experience with that, especially because everywhere you turn, including a recent cover of Businessweek, there are both like big questions about, but also increasingly still big opportunities in the SPAC world. Tell me about your experience there.
Yeah, we like where the space is right now, because I think what's happened is you've basically eliminated a lot of the amateur players that just want to participate in the space because it's hot. There's real institutional offices that you need. You need to do real due diligence. And there's a lot of good companies out there that are SPAC worthy, but it's really kind of leveled out the playing field a little bit. The reason why we love SPAC is, number one, I have a wonderful partner in Hamanchu and Antar, is a 50-50 partnership. They have an incredible track record. They've returned north of 40% in their hedge fund over the last 3 years, 58% last year. And why we came together is we feel that ARC is tailor-made for SPACs. I mean, we have more deal flow than we can, they're coming out of our ears. But the barrier to entry has often been the capital. And with the SPAC, we have the public money. and we have the deal flow, and collectively with Antara, we have the back office to bring the best opportunities to these companies and then help them go from good to great by bringing in our expertise, our market share, and how to really tell the story. A lot like we've done with companies like Petros Pace, Hims and Hers, Saunders, companies in our portfolio that either have gone public or soon will be going public.
So what's your day-to-day like at this point? I mean, I look across the portfolio, I look at some of the things you're involved in. You know, you have your hands in so many different things. How do you break it up? How do you divide your time? I mean, this has to be something of a time management challenge, if nothing else, Alex.
Yeah, you know, I'm very fortunate to have great people around me. I mean, I have 3 really strong women that run our companies and our portfolio. I have Lisa, who runs our investment arm. We have Kelly, who's my chief business officer, and she runs everything that we touch. And then we have Aaron Knight and Stuart Zook, who run our real estate. And really, they run their own business. I don't micromanage. They tell me really what to do. They're way smarter than I am. But really, again, when you have the VCP, and I think we have that at AROD Corp, you're able to do a lot of great things. And I'm able to kind of roam around and bring value at the highest level with great relationships with like the Blackstones of the world or Barry Sternlit or Mark Laurie. And then I let my teammates do what they do best.
So, you know, you mentioned some of those names, and it's interesting to talk about this kind of intersection, which you and I have talked about before, of kind of finance and sports. I would imagine, just being who you are, just speaking very plainly, that many doors are open to you, and yet you still have to walk through them, and you still have to sit down at that table, and then the conversation goes from there. What have you learned in that process of kind of getting from, hey, it's nice to meet you, sure, we can take a picture, to actually getting a deal done, actually doing business?
You know, that's a great question, because this is something that Magic Johnson and I joked around back 15, 20 years ago, which is, you know, as an athlete, as an entertainer, you pretty much have any door open to you. People will take a meeting, they'll want a picture, you sign an autograph, they have kids and grandkids, but usually nothing happens after that. What we learned is the doors will open. You have to be prepared to be open. You have to know your stuff. You have to have an A+ team to be able to follow up and execute. Because when you walk in the door as an athlete or an entertainer, you have to understand that what the business person is thinking is they're not going to follow up, is going to be flaky. They don't have a capable team. They run a licensing model, not an ownership model. So you have 2 strikes walking in. You have to come in and really know your stuff, be well prepared, and have a world-class team to be able to execute in all these doors opening. If not, it's just an autograph show.
And so talk to me about that difference between licensing and ownership, because clearly that is a key theme that you have pulled through. Comes with more responsibility, more complexity, and so in general, that's just harder to do. It is relatively easy, and again, I'm just speaking plainly to you, when you are as famous as you are, people want to put your name on something, and that will help their sales. It's a whole different thing when they're bringing you on as an equity partner, as someone who has a say, but also has the responsibility to carry it forward. How do you adopt that mindset, or what are the tools you need to use in order to actually execute?
Licensing model compared to an ownership model are completely different. If you think about a licensing model, you get CAA or WME, whoever your agent are, they'll go out and do a deal with, you know, Nike or Mercedes-Benz, and it's a 3-year deal. You get paid a few $1,000,000 a year, and that's pretty much it. It's really simple. When you think about building businesses, it requires time, effort, resources, an incredible team, an institutional team to be able to build, because it's really hard to do, right? And it takes more time and energy and a different set of skill set, right? So it's not for everybody, but if you do it, you have to do it right. And the upside is much greater, but there's so much harder work to be able to execute that.
And so, you know, you mentioned this earlier, Alex, this notion that this generation coming up behind you is much more candidly sophisticated. They're much more, I would say, ambitious from an earlier age. I mean, you were an outlier in some ways, kind of the exception that proved the rule. The rule, it seems now, and this is based on conversations I've had with kids coming out of high school into the NBA or into Major League Baseball or into, the NFL within a couple of years, they're thinking about these things much earlier. Why do you think that is, and what are the implications of that?
Well, when I grew up, for example, Jason, I wanted to be just like, Cal Ripken or Magic Johnson and Larry Bird or Dan Marino. And that was it. Today, kids want to come up and they want to be more like Mark Cuban or Mark Laurie or LeBron James, who's both. I think there's a shift in thinking. There is a much larger ambition. There's more transparency out there. But I would say that there's a shift in power that's happened over the last 10 years. But more specifically, over the last 5 years, the power has shifted to the talent and the entertainer. And what that means is that you couldn't think 15, 20 years ago that an entertainer like Kim Kardashian can actually beat a KKR or a Blackstone on a particular deal. But the truth is, in today's world, she can. And that's really cool and is really fun. And it democratizes things a great deal. So with that, I think there's an adjustment being made right now of like, okay, institutions actually need the talent. But if you do it right, 1 + 1 should equal 11.
And so there is risk, though, in sort of taking that on, because just going back to what you said before, a licensing deal, pretty low risk. I mean, you're getting a check and, then you sort of go off and do what you're going to do. And so how do you factor risk into all of this?
Listen, I would say that sometimes a licensing deal is exactly the right thing to do, right? I mean, if you have a wonderful company like a Nike or a Starbucks and you want to do a partnership with them, fantastic. I think it's just like playing a different sport. When you're building businesses, you need different team members, different commitment, different alignment. The way you structure pay is completely different. With the licensing deal, you need one agent, one manager. They do the deal. Everybody gets their money. Agent gets 10%. You get 90%, and you're off to the next, right? And you fill out your obligations. With a business, you can build it for 10 or 12 years and not collect a dollar. And are you willing to do that? Are you willing to architect the team? Look, 99% will say, no, I don't need that. I just want to be on a boat and go enjoy my life and play golf. And there's nothing wrong with that. So you have crazy people like me and Magic and Greg Norman and others that really have wanted to be excellent both on the baseball field or the sports field as well as the boardroom.
So with 2 minutes left, I'm going to ask you a really big sort of sprawling question. But it does strike me as you're talking about this and we're talking about, your future as an owner, it feels like over the last year, our relationship with sports has changed and maybe deepened, our relationships with athletes, how athletes see themselves. Do you feel that in this moment? You mentioned LeBron. We think about the activism in the NBA and the WNBA that we saw in the aftermath of George Floyd's killing and Black Lives Matter and all of these different things. What's changed about our relationship with sports and teams?
Well, I think it's just gotten to be even a more important platform. I mean, there's so much pain around the world. So many people are suffering with these tough times, whether it's health or financially, or just really not knowing what the future holds. And I've always said that in times like this is about bringing people together. And nothing brings people together more than music and sports. And I think moving forward is even a bigger responsibility and a bigger platform to be able to not only run a great business, but to do a lot of good in those communities around these sports franchises.
All right, so only about a minute left. What haven't you done that you still want to do?
I've never skied. I want to try skiing. That's one thing I want to do. But, through my sports career and my contract, I wasn't allowed to go skiing. So my daughters are trying to get me out on the skis, which will be a pretty funny sight, I bet.
I have to say, when I asked that question, if you had given me 100 guesses as to the thing you wanted to do, I would not have guessed skiing. Anything on your business agenda, anything you want to do from a business perspective that you haven't done? Again, the portfolio is wide ranging at this point.
No, Jason, my focus is to continue to help kids with, brown skin like me that came from the bottom with a single mother who were the complete underdogs, who nobody believed in me. And I just love the ability to, what the Boys and Girls Club did for me, the great mentors that I've had, what they've done. I will continue to be involved very much with the Boys and Girls Club. We put about 40 kids through college. My goal is to put 400 or 1,000 kids through college at the University of Miami. And I'm indebted, and it's my debt that I have to go out and pay back and do good in the world.
Alex Rodriguez, really good to talk to you. I could spend another 2 minutes just going through all your various titles, and we could talk all day about your ambitions and everything next. Thank you so much.
Thanks, Jason.
Hi, and welcome to How I Got That Story with Bloomberg Businessweek. We're here to talk about this amazing story that we've run about the $20 billion loss by a single trader that shook the markets. This was an incredible story. Sometimes the pieces we do that are as richly reported as this are the result of months and months of reporting and preparation. This was a story that happened so fast, nobody saw it coming, and this reporting team really had to scramble. Eric, let's start with you. Tell us just kind of briefly what this story is about, and tell us sort of like how it came on your radar, because this was really a situation where, Bill Hwang, when he was incurring these losses, almost nobody on Wall Street knew who he was.
You're absolutely right. I would say that, like so many stories of this nature in finance, it's a story about greed. It's a story about hubris, perhaps hubris more than anything else, right? And it's a story about the perils of leverage. You had an individual in the name of Bill Hwang, a former hedge fund manager who had started his own family office with a few $100 million that he'd made in the course of his career, but then operated invisibly for years, almost a decade, amassing a fortune that at its peak exceeded $20 billion. Now, that in and of itself is amazing, to make that much money out of the sight of the rest of the financial services industry, known only to a handful of bankers and brokers. But what makes this story truly remarkable, Pat, was that he lost the $20 billion in the space of 2 days. Things went so horribly wrong, in part because he had so much leverage that he lost it. He lost more money. One individual lost more money faster than anybody else ever had before. It's just, it's more than extraordinary. It's downright shocking.
And the important thing there is when you say that he lost so much because he had leverage, leverage means that he's borrowing money, in essence, from somebody else. And that meant that his losses were not just his losses.
Precisely. His losses ended up being his bankers' losses, from what we understand at this point. And the numbers are still rolling in, believe it or not. The banks that loaned money to Bill Hwang lost, in aggregate, more than $10 billion themselves, which is, again, an indictment of leverage, in the sense that it's one thing to be the borrower and lose the money. It's another thing to be the lender and lose the money. It is a story there of the failure of risk management, irresponsible lending. The list goes on, and the names involved are some of the arguably most reputable in the financial services industry. We're talking about firms like Morgan Stanley. We're talking about firms like Credit Suisse. We're talking about Nomura. We're talking about UBS. These are some of the largest and supposedly best run banks and brokerage houses in the world.
Cathie, let's talk a little bit about the world that Bill Hwang came from. He is often spoken of as having run a family office, but really functionally he was running something that was more like a hedge fund. Can you talk to us a little bit about the hedge fund world and these kinds of traders, and specifically how Bill Hwang came up and became somebody who could be placing these kinds of bets?
Sure. Bill Hwang, his first job at hedge funds was with Julian Robertson, who is one of the icons of the hedge fund industry. And Julian picked him out actually of a securities firm where he was a salesman, and he helped Julian do very well in some Korean stocks. And so Julian said, okay, come on board and join Tiger Management. And he had a very good career there. He made a lot of money for Tiger Management. And when Julian closed his hedge fund in the early 2000s, Bill went out on his own and started his own hedge fund. And he had mostly very good returns, although they were volatile because he made big bets even then, even when he had clients' money. And he ran that fund for a few years, and then he got into a little trouble with the regulators in Asia, and he closed down his fund. And it was at that point that he became a family office.
You know, what really struck me about this story as we were editing it is hedge fund strategies are often a little hard for ordinary people to understand. But at least certainly by the time his fund got into trouble, he was doing something that I think might actually have been pretty familiar to a lot of people who just trade in the stock market.
Absolutely. He bought a handful of stocks. There were 11 or 12 of them that we know about. And he just kept on buying them and held them. He didn't trade around them. He just picked companies he thought were good and bought them.
Shri, talk to me a little bit about sort of like what you were kind of hearing from the banking world and the investment banking world when all of this began to unravel.
I mean, the crazy part of all of this is how this came to be. Leading up to the final days of March, no one really on Wall Street, at least the broader financial community, had even heard of Archegos or Bill Hwang. But then you saw this frenzy of block trades that hit the market in number of stocks across the board, dropping in value really fast, and everyone puzzled as to what the hell was going on. It's only in the next few days that we were able to piece together the different parts of the puzzle and find out that this was one family office, one single client was able to cause so much damage, not just across markets, but also for the balance sheets of these large multinational investment banks. And that is what made it so extraordinary. The fact that you have a case of an individual losing so much money so quickly, but also dragging down some pretty well-known big-name institutions along with him.
Can you talk a little bit about sort of why these banks weren't able to kind of work together to limit to limit the losses? Because one of the things that happens is, when someone is very leveraged and experiencing a lot of losses, a lot of it can kind of come down to, who's going to be the first bank to say, "Give us our money back," and then things quickly unravels. Do I have that right?
Right, and in this case, when his portfolio was going down, if Bill Hwang had gotten a margin call from one bank, he would still have been in a decent position. But this was a situation where he had built up relationships with a number of banks, a dozen prime brokers across Wall Street in the US and Europe and beyond, and all of them had the demand at the same time. This was a burning house. Everyone was trying to get out fast, dump their holdings, save their skin. Some of them managed to do just fine, like Goldman Sachs, like Deutsche Bank, like Wells Fargo. The others were left stuck in that house.
Shri and Cathie, in the end, what have we learned from this and these events that happened? Particularly now that kind of the market has had a chance to digest what's happened.
Well, one of the most interesting things, I think, is the use of derivatives and how Bill was able to hide all his positions so that the world didn't know he had them, the banks didn't know he had them collectively. And so we might see some regulations coming down the pike about whether people have to list these sort of derivatives with the SEC. So that's one thing that we're kind of looking for going forward. Tree?
And I feel as important as trying to figure out what we've learned is also trying to understand how long will we remember the lessons from this episode. Because if you look at every major financial fiasco going back decades, leverage has been the common theme. There is a lot of hubbub and cry and noise around it during the moment. But once we move past that, that creeps back into the system and it shows up in different places at different times and repeats itself. So how do we ensure that this does not become a problem going forward? Is a tough one, is something that regulators will look at, is something that banks and other institutions will be paranoid about for now. But just how long that paranoia lasts, we'll find out.
Markets often have pretty short memories. I think that's a great point to end on. Thanks so much, all of you, and thanks for the fantastic story.
Hi, everyone. I'm Carol Massar of Bloomberg Businessweek Radio and TV, and I'm delighted to bring in Cathie Wood. She's the founder, CEO, and Chief Investment Officer of ARK Investment LLC. She is someone who is well known to our audience. Her consistent performance since she started ARK about 7 years ago has certainly given her a lot of notoriety. Cathie, first of all, thank you for joining us. I know it's a crazy day. We're all watching the markets. We're all watching Bitcoin in a big way. The crypto market is coming undone. Last trade was about 35,000 on Bitcoin. What's happening right now, and how low do you think it can go?
Well, I think we're in a risk-off period, and for all assets, if you look at the stock market, the more risky or volatile parts of the market have come in dramatically since mid-February, and I think a lot of the concerns have been around inflation. Initially, that was helping Bitcoin because obviously Bitcoin's a very important inflation hedge. You know, it's a rules-based monetary policy, the first global rules-based monetary policy we have ever had. Hugely important reserve currency of the crypto asset ecosystem. But I think what's happening right now is because the stock market, the highly volatile part of the stock market, the innovation-oriented part of the stock market has gone through such a correction, which has been flamed by inflation fears. I think the correlations among volatile assets are going to one right now, and that's including Bitcoin.
Well, I want to unpack a couple of things. So Bitcoin, I mean, you at one point, I think back in April, told Dow Jones that it could go to about $500,000. Do you still hold that target? Do you still think that's where we're headed?
We do. I do. Yassine El-Mandra is our crypto analyst, and we go through soul-searching times like this and scrape the models. And yes, our conviction is as high. The one thing that has changed here, however, is the environmental concerns around Bitcoin in particular have caused people like Elon Musk to pull away and say, whoa, 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 let me make sure I understand this. And we believe that even this is going to change because, first of all, right now, the percentage of Bitcoin mined with renewables and hydroelectric power is quite substantial. I think in China, it's over 50% in renewables. And we also believe, and we wrote a paper in conjunction with Square on this, and we're going to have a conference about it in July. We believe that Bitcoin mining integrated into the distributed grid, and by that I mean solar roofs, power walls in homes, utilities, merchant power producers, starting to include Bitcoin mining in the ecosystem. Why would they do that? They would do it because renewables are intermittent power sources, right? Weather, is it sunny or not? Wind, is it windy or not? And Bitcoin mining could take off if there's excess energy from solar being loaded into power walls, it can be offloaded into Bitcoin mining, and the whole ecosystem, therefore, becomes much more economic. If this happens, we believe that the adoption of solar is going to accelerate dramatically because there's another profit center associated with it, Bitcoin mining.
Well, what happens though in the meantime? So here we are at 35,000, Cathie. Do you think we go much lower from here?
You never know how low is low when a market gets very emotional. A lot of traders see Bitcoin dropping below the 200-day moving average, which was at 40,000. So traders, once that happened, they just dump. Some just dump and run. I think we're in a capitulation phase. Yassine has a dashboard. We were looking at all the indicators this morning. They are all suggesting that we are in the capitulation phase, which is a really great time to buy, no matter what the asset is. A capitulation phase is buy. It's on sale. Now, am I saying 35,000 is the low? You know, if traders, and there are a lot of speculators in Bitcoin, if they are running for the hills just because Bitcoin has broken through a moving average that is important to them. It could continue, but all of our indicators are saying this is capitulation right now.
Do you have a low point on your model for Bitcoin?
No, these metrics are more a measure. Are we in a truly capitulation phase?
Okay.
And it's very detailed. Yassine uses on-chain analysis, which this is the only asset where you can see exactly who's doing what, when, why, and how. And all of those metrics are saying this is a capitulation. This is as bad as it got during the coronavirus crisis.
So what about systemic concerns? And I'm not talking about bringing down the financial system, but you know more and more of kind of the establishment are getting involved in Bitcoin. A lot more companies have Bitcoin on their balance sheet. Should we be concerned about their exposure? Tesla, for one, but others?
Yes. Yes. Well, they're usually, in the case of Square and Tesla, they're between 5 and 8% of their cash is in Bitcoin. So that's no cause for concern. I mean, think about it. We were worried that Tesla would run out of cash. Of course, ARK was not worried, but the world was worried 2 years ago that it would run out of cash. It has so much cash now that it has the luxury to put 5 to 8% in Bitcoin. So MicroStrategy is another company. It has almost all its cash in Bitcoin. That's perhaps something different, you know. But as I said, if we are in the capitulation phase, we shouldn't be worried about MicroStrategy either. We do believe this is a new asset class and that institutions, they are looking at it right now because the correlations of relative returns and total returns compared to other asset classes tends to be very low over time. And so they have to look at it. Now, ESG might prevent a move in wholesale, but we do believe that once they understand how renewables are becoming incorporated into the Bitcoin mining ecosystem, and that Bitcoin mining might accelerate the adoption of solar, and I think Elon will come back and be a part of that ecosystem as well.
So why do you think he came out and said, wait a minute, maybe I'm going to back off of Bitcoin? What do you think his concern was? What was his nervousness?
Well, I think he moved in because he's been watching, like we all have, basically unhinged monetary policies. They're not tied to anything anymore. Whereas Bitcoin is mathematically metered to top out at 21 million units, and we're approaching 19 million now. So the scarcity factor should increase and support the price. We do believe that is what is going to be supporting the price in here. I believe what happened after he took the position in Bitcoin is he got pushback from institutional shareholders like BlackRock. If you've got Larry Fink, beating the drum on climate change as one of the most important topics and problems of our time, then he was going to have to face those sorts of concerns. I don't think he expected that. And now that he's sorting it out, learning more about the environmental impact, I think he'll come back into the mix. We certainly hope he will. I don't know if he's going to be part of the conference in July or not. He would be a very good addition because I think he would provide both sides of the equation. How quickly could the adoption of solar accelerate if we introduce mining into that ecosystem?
Do you expect a Bitcoin ETF to get approved anytime soon? And I'm curious if you plan to launch a crypto ETF anytime soon.
I think now that Gary Gensler is head of the SEC, he's Bitcoin friendly. We know that. He taught a class, courses at MIT before coming back to the SEC. So, and I think the research professionals at the SEC. They understand Bitcoin in particular, and I think are much more comfortable with it now that we've had several years to digest what exactly it is, go through a bear market, go through a bull market, now go through a bit of a bear market. I think watching the ecosystem evolve and actually become even more anti-fragile. You know, we're getting some real tests here. And if the system doesn't break, and I don't think it will, I think that their comfort will increase in a couple of ways. Number one, the infrastructure is there, is robust. Number two, the liquidity is there. I don't think that's going to be disproven here. And number three, the price is down from very lofty levels. So, hey, why not start an ETF after a correction in the market than before? So I actually think the odds are going up now that we've had this correction. I don't know if it's going to be this year or not. We hear perhaps fourth quarter, but we heard third quarter before that. So as we get closer to the fourth quarter, we'll know how much is being pushed out.
Hey, I want to ask you a little bit more about Tesla. Obviously, you've been out there front and center years ahead when everybody was turning their backs on Tesla, taking another hit. The news out of China, they have certainly had some tough time. Their growth has slowed substantially. They've had a lot of headaches and protests in Shanghai after some accidents with its cars. Is the Chinese market at risk for Tesla?
I think the China is going to favor its local producers like NIO and others, XPeng. And I think they're granting subsidies to NIO, which is the battery swap company, even on its very high-end cars, which they are not granting to Tesla. So it's obvious, and it has always been obvious, that China would favor a local producer. But what we are seeing from China, and particularly Tesla, is exports into Europe. Where it does not yet have a plant. And what we're hearing is especially in Germany, but all over Europe, where their standards are extremely high for cars in terms of design and performance, that they would prefer cars from Shanghai, which is a much newer plant, and much more productive, much more efficient in terms of perfecting these designs than is Fremont. And so I think we're seeing a big export market develop from China into Europe. And I think China will like that. China wants to be known not for shipping or exporting, cheap goods, but also high-end goods. So this could be the beginning of a trend. So is China at risk then for Tesla? I mean, I don't think they're going to shut down the factory at all. I think that factory will be used much more for exporting than we once imagined. I will say that Tesla's cars in China have sold very well until very recently. I'm sure the publicity it has received has cooled Tesla's jets in China, but it's been fortuitous that this export market has opened up at the same time.
Cathie, one thing I want to ask you, and we talked about it at the beginning, inflation. Your mentor, you and I talked about this just a few weeks ago, Art Laffer, you were in your 20s, you were focusing on the economy. It was a time where inflation was off the charts and everybody thought it would consistently stay that way. Laffer thought differently, and we know, well known in the supply side economics. Here we are at another time where the markets, the volatility is often guided by our inflation expectations. Is inflation going to be a problem in your view?
Well, we've been saying for some time, actually since the depths of the coronavirus, we were doing YouTube videos saying regularly, V-shaped recovery, businesses are way behind consumers. Consumers are buying all of these goods. In fact, that's all they can do because they're stuck at home, right? So they were buying non-durable and durable goods that could be shipped to them, right?
Right.
Okay, that part of consumption is 1/3 of consumption, and a disproportionate amount or percentage of the market basket of consumers was in goods for the past year. businesses didn't expect it. They were behind even before the coronavirus. They had been lagging in terms of capital spending, in terms of inventories. They were worried about inverted yield curves and China-US trade conflict. There were many, many concerns. So they had been dragging their feet. They got even further behind and still haven't caught up. So what's happening now? Double, triple ordering, maybe quadruple ordering, because they just can't get the goods.
Panic
especially
buying. We've been talking about companies panic buying too.
Panic buying. And so what I believe is we are setting up for a massive period of deflation. Now, let me explain that. There are three sources of deflation. One is when the orders, these double and triple orders, are canceled, right? Now, we have seen lumber correct 30% in the last week. I think this is the beginning of that. Copper is now starting to correct. And I believe that commodity prices went too far, too fast as businesses were scrambling and panicking, right? They were losing business to competition if they hadn't planned their inventories correctly. So that's one source of deflation, but that's only cyclical deflation. And we actually didn't expect it to start now. We expected it to start later in the year. But I guess it makes sense now that vaccines are here and consumers are shifting away from goods towards services or at the margin. The writing is on the wall. Those are double and triple orders are going to be canceled. Prices were too high, and we're probably going to see a drop in commodities. But there are two other sources of deflation out there, and this is what we've been saying for quite some time. One has to do with, it's a good deflation. It's caused by technologically enabled innovation. And we believe when you see DNA sequencing costs dropping 40% for every cumulative doubling in genome sequenced, or when you see AI training costs dropping 37 to 50% per year, these are massive deflationary forces that are going to hit every part of the economy. AI is going to be everywhere. So that's good deflation. Now, what's bad deflation? Bad deflation is going to hit those companies that are going to be disintermediated and disrupted by all of the innovation that we talk about all the time, based on DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. So companies who have leveraged up to satisfy short-term oriented shareholders who say, I want my profits now, I want my dividends now, so they buy back their shares, they haven't been investing enough in innovation. They are going to lose, if they're not lucky, if they are unlucky, they will lose their businesses.
So Cathie, what I like about you is your consistency, and we have been talking about these themes, right, for a long time. Having said that, you know your performance has been really consistent. It's been a tougher year this year, and you've had flows out of your funds. I was tracking just, I think, over the last week, it's almost $1 billion. So, you know, how do you keep your investors kind of energized in your philosophy and your thinking and your outlook and confident in your strategy, you know, in a moment where there's a lot of doubt out there?
Yes, well, a couple of things just in terms of flows. In our biggest outflows were in March. There are a lot of commentators out there, shall I say, screaming about how ETFs would have to, or our ETFs would have to shut down, which is impossible, and they just don't understand the ETF infrastructure surrounding us. It's a beautiful thing, let me tell you. The flows are no problem. Our spreads have not moved. But anyway, beyond that, what has happened is our price targets for the next 5 years, that's our investment time horizon, have not changed, right?
Not at all. Yeah.
In fact, some of them have gone up as quarterly results have come out. Now, they're not going to change that much because that one quarter's result is not going to change a 5-year price target by that much. But the forces that the coronavirus put in motion, supporting all of the innovation in which we invest, they are not looking back. And so what we are seeing is, you know, a 30 to 40% discount to peak prices in February for the same price targets. So we're looking at this saying, all right, on sale. Innovation is on sale. And oh, by the way, the bull market has broadened out. It is now embracing value and more cyclical stocks. So what has happened is the bull market has broadened, has strengthened, and that is usually a launching pad for our next move up. This happened, if I can just say, 2016, same thing. Fourth quarter of 16, after Trump, against all expectations, was elected, value stocks took off because we were going to have a big cycle, tax cuts, right? And our strategy went down. We were negative. But what happened was 2017 was one of our best years ever, save last year. And that's because the bull market had broadened out, included value, cyclicals were taking off, and the economy was on the mend. Our economy is very strong right now, and cyclical earnings growth and revenue growth is a competition to innovation. But if we're right on what's happening with commodity prices right now, and that's going to be extended, that is the ticket to the next move in our kinds of stocks.
Well, it's interesting too. What about though the tech underperformance, Cathie, that we've seen? How much longer do you think, we see that?
Well, you can never say when we've hit bottom. I mean, I can tell you that the valuations in our portfolios would suggest that over the next 5 years, again, if our research is correct, no promises. We believe that our portfolios will more than triple over the next 5 years. So that's more than a 25% compound annual rate of return over the next 5 years. Actually, it's approaching 30 after today. So, I'm looking at that with great confidence because these innovation platforms have hit escape velocity, and there is no turning back. There is no turning back because they are helping businesses and consumers back to the old world.
There we go.
Yes.
Little free.
Sorry?
There we go. You're back. Go ahead. No, that's okay. You're freezing up. Go ahead, please.
Oh, sorry. We're not going back to the old world. We're not going back to the old world. So, my confidence has only increased in our strategies.
Can I ask you, why did you guys get out of Apple? Your position in Apple?
Okay, what we do when a bull market is as extended as the move into our type of stock is as that move happens, we start
We're freezing up a little bit. Let's see if we can get Cathie back. There you go. That's okay. Innovation, it's happening, but not always when it comes to the virtual conversation. Go ahead. You were talking about Apple.
So Apple was one of our cash-like instruments. It's an innovative company. It's in the innovation zone, but its characteristics are very defensive. So we will add names like Apple, the FANGs, Apple, Google, Facebook. We will add to those positions, or even reintroduce those stocks. As a bull market, our portfolios were up 150%. We knew there was going to be a correction, and we just wanted to have very liquid stocks. Apple is a great company. It's going to do fine. It's a FANG. It's in a lot of portfolios. We are all about the next FANGs, but we will use the existing FANGs. If you see, they are acting very defensively. Become a defensive group. So we will fold them in, increase them when we see a move like we saw last year. When we see a decline like the one we're seeing now, we're seeing much higher returns from the other stocks in our portfolio.
You were talking about kind of value and cyclical, and I'm curious, are there any value and cyclical strategies right now that you guys have identified as ones you want to pursue?
Well, in our space strategy, ARKX, you'll find a lot of value-oriented stocks. Many people are surprised to see deer, for example, in there. And what they don't understand is thanks to satellite technology and the increase in the number of satellites out there and the precision that we're getting from them, we are now enabling precision agriculture with autonomous tractors and drones. So without that constellation out there, that would not be happening. We think the two biggest applications or beneficiaries of the space race are satellites going to enable mobile connectivity or connectivity around the world, broadband connectivity. It is really hard for us to imagine that 3 billion people in the world have no access to the internet or broadband. This is going to enable that, satellites, and also farming. And the other thing we think is going to happen much sooner than space tourism, or it'll be a much bigger deal in terms of revenue generation, is hypersonic flight. So any aerospace company focused on hypersonic flight, we're interested in. And they tend to be value stocks.
You mentioned earlier, there have been people who have been very vocal and public fans of you, and then some now have become your critics, or they criticize, having a younger investment and, group of analysts, your analyst team. What do you say to them?
I would say that's our secret weapon. Those analysts have their education and their feet in the new world. The most seasoned analysts, healthcare analysts on Wall Street, and God bless them, they've been great at what they do. Anything, they know all the code words and how to decipher them from the FDA. But they probably haven't experimented with CRISPR gene editing like our genomic analysts have. And they don't have advanced degrees in cognitive computing, including bringing behavioral science into it. So many of our analysts are coming to us directly from college, and they are fully equipped with domain expertise in a way that most analysts out there, again, very seasoned, are not, just because they didn't go to school and haven't been exposed to these new technologies. Now, I know there are a lot of PhDs out there, and they, of course, know a lot. But I would put any of our analysts up against the most seasoned analysts on the street when it comes to the topic of innovation and new technologies, right? That's our focus. And so why wouldn't we? I think we have a competitive advantage for a few reasons. Number one, our analysts, their domain expertise. Number two, their willingness to engage with the communities out there through social media and give our research away, not when it's finished, but as it's evolving, so that they can communicate and engage with the innovators themselves. So I think we have a competitive dynamic unmatched out there in the industry.
Hey, just to wrap up, Cathie, and you and I have been talking for a lot of years. This has kind of been a year that's unusual, I would say, in some regards for you. What have you learned in the past year, and what does maybe change mean to you?
Well, as we were having such an incredible year last year, and I do think the coronavirus crisis caused it, innovation solves problems, I kept saying to everyone, everyone in the company, we must stay humble. We must stay humble, and we know this is going to come to an end. We're going to go through a severe correction, and we have to just keep our heads down, focused on our research to keep our conviction and drive our strategies forward. That's what's happened. Keeping our heads down, hopefully staying humble, and really trying to educate people. The great opportunities available out there. Get on the right side of change. This is going to be the most amazing period of my investment career. And I've been through 40 plus years because we've never seen 5 innovation platforms evolve at the same time, all of them leading to exponential growth trajectories that are going to transform people's lives. And so I say just, read our research, talk to our analysts on Twitter if you really want to learn more, and join the ride, because we believe it's going to be magnificent.
Just quickly from the audience, do you ever get recognized in public like a celebrity? Some people liken you to Warren Buffett. And do you ever miss kind of your pre-rock star days? Just quickly.
The answer is yes, much to my surprise, even in an island off of New Zealand, which is what. And no, we are honored and delighted because you know what, and I know it's been hard for our clients in recent months, keep the faith, but many people's lives have been changed by what happened last year. They put they allocated resources towards our strategies, towards Bitcoin, and they had a magnificent run. So it's gratitude that we feel. Now, of course, we're feeling very responsible, of course, this year, but that's why it's so important for us to say, you know, that what pains me more than anything as a portfolio manager is when I know our clients are selling at the bottom. And it usually is that people sell. The big capitulation that I described earlier with Bitcoin is selling at the bottom. So you make a terrible mistake and you don't want to ever get in again. And it just pains me. So I'm just praying that we don't have a lot of that. We've had a lot of retention. Just to correct one thing you said at the beginning, actually, as a firm, we've not had 1 month of redemptions. The ETF platform had, if you go month end to month end, which is how we measure this sort of thing,
right?
Our redemptions in March were 500 million. We've had positive flows in April. May, it remains to be seen. It's been nip and tuck. It may end up being a small, depends on what happens in these last few weeks. But, you know, if there's real capitulation, sure, we could have a big outflow, but I think that's capitulation. So.
All right, we're going to leave it on that. Cathie, thank you so much. I know it's a crazy day. You always find time. Thank you. Thank you. I really appreciate it.
You always. We've been together since 2014, so thank you.
Cathie Wood, of course, everyone, of ARK Invest. Thanks, Cathie. Take care.
Some people get a look in their eye when they find out I cover economics for Bloomberg Businessweek. They want to make money. They're like, so what do you say about the economy? Or what do you think the stock market's going to do? I'm like, please get me out of here. I could tell a story, but I have no idea. I mean, really, no idea. I'm tempted to be sarcastic. Oh, glad you asked. Of course I know the answer. My perfect foresight is maybe inconceivably rich. I own 2/3 of Eurasia. Instead, I'll go, well, the median forecast of economists surveyed by Bloomberg predicts U.S. gross domestic product will grow 5.8% this year. Median estimate for the year-end S&P 500 is 4,100. Is that helpful? It's a perfect way to end a boring conversation.
All right, keeping the Bloomberg Businessweek conference going. And of course, we're going to continue here on this topic on cryptocurrencies. A great interview, of course, just there between Carol Massar and Cathie Wood. We're going to joining us right now is Brian Brooks. Of course, he is the U.S. CEO over at Binance. And of course, he has a long career in the banking and finance industry, including over at Coinbase, at Fannie Mae. Most recently, of course, he also served as acting comptroller of the currency. Brian, thanks for being with us today. Obviously, we had a very sort of, I guess, planned out agenda of what we were going to talk about, but we have to get right to the news of the moment here, Brian. And I want to get your thoughts here on some of the moves that we've been seeing in the cryptocurrency space today, and specifically about the volatility surrounding that. Your platform has had some issues, or at least has been reported here by Bloomberg and other folks here. Where does your platform stand right now with regards to allowing people to transact?
Well, so first of all, Romain, thanks so much for having me. This is definitely a different day than any of us were hoping for a week ago. But what I would tell you is there's great news, and then there's sort of hopeful news on the Binance US platform. The great news is that the platform is amazingly resilient. We transacted almost $3.3 billion on our spot exchange in the last 24 hours, which I think is an all-time record for the exchange, and it's held up very well at a time of rapid transaction. The issue we have, quite frankly, is that we have way too many customer support issues on backlog. And I want everybody in the Binance US community to know we are all over this. I mean, we have 3 or 4 major initiatives that are going to fix that in the coming weeks and months. One of them, Romaine, is we hired one of the most noted leaders of customer experience in the technology industry, a person who took Comcast from one of the worst customer experiences in America to having one of the highest net promoter scores of any brand in America. She's joined Binance US to fix this. We've got a self-service kiosk coming online very shortly that's going to allow people to solve their own problems for the 5 or 6 most common reasons that they're sort of having a hard time onboarding. And we're migrating risk logic from an international platform to a US-based platform so we can control the kinds of risk changes right here in the US that are causing some people to have access issues. So I know it's a big deal. I've got that feedback, but we're all over it, and you're going to see a different customer experience very shortly.
All right, it's certainly a big deal. One of the reasons why we have you on, one of the reasons why we're having this conference is because over the past year, really the past couple of years, we've seen this migration to, I guess, what once were alternative assets that to a certain extent have now become mainstream assets. But being part of the mainstream also means that there needs to be some degree of stability or at least some degree of predictability, at least on a relative basis. Does cryptocurrency actually have that?
Yeah, Romaine, it's funny. I was looking before this interview at the chart of how the Dow Jones is performing today. And the Dow Jones is in a straight line, I don't want to say it's in a free fall, but it is a straight line down over the last 24 hours. And somehow nobody's reporting that story. Same thing with the US dollar, which has been debased to the tune of about 40% over the last year. That's why you're seeing historically insane inflation levels. But nobody's writing that story either. They write about crypto because it's new, and they assume that the status quo is kind of the risk-free zone. It really isn't. Markets are going down right now because there's a lot of strange things going on in the world globally, in the world of U.S. domestic policy, and crypto is one of the victims of that. But it's not the only. It's not the only. I mean, volatility is inherent in investment market. We're going to see it here too.
Absolutely. Absolutely. But the volatility that we see in the Dow, the dollar, and some other assets, typically the drawdowns that we see there tend to be, I guess, a little bit more restrained here. When you have 30% drawdowns in a single day here on an asset, I don't know if that's fair to make a comparison to some of the drawdowns that we've seen in the dollar or in equity markets.
Yeah, it sort of depends on what your risk tolerance is. I mean, if you're a retiree living on a savings account, I think the decline in some of those other assets are just as big a deal as part of your day-to-day as they are for crypto investors. But at the same time, Romaine, we have to ask ourselves, why is this going on in crypto? And the answer is sort of severalfold. I mean, one is there's a fair amount of misinformation going on in these markets. So, from Elon Musk tweeting to misinterpretations of what China actually said yesterday, those things get filtered in a very weird way. And even more important in this country, we haven't yet built a two-sided crypto market yet, the way that we have in every other traditional asset class. In the United States,
what do you mean by two-sided?
So what I mean is you can basically only be long crypto in this country. You can buy Bitcoin or you can sell Bitcoin. What you can't do is engage in Bitcoin futures, derivatives, swaps. These are things that bring price discovery and stability over time. And we need to get regulators comfortable that those kinds of things are positive, not a negative in this asset class, which I think we'll get to eventually.
There are probably a lot of people nodding their head at the comment that you just made. And for every person that's nodding their head, there are probably just as many people shaking their head and saying they don't want that regulatory scrutiny. They don't want that regulatory involvement. What's your response to that?
Yeah, look, I mean, what I tried to do in my last job in the government running the banking system was to say we're not fans or enemies of crypto, but we do believe that markets need clarity. And so, I'm not saying that more scrutiny or less scrutiny is a good thing, but having a set of rules would be great. I mean, imagine roads with no speed limits, right? I mean, nobody knows if you should drive fast or slow, and so it's super dangerous. And then you have a speed limit and everybody knows what the rules are and they can then adjust their behavior. We need that in crypto pretty urgently.
But hasn't the lack of rules in crypto, hasn't that been for a lot of people the attraction?
I don't know that that's right, to be honest. I think the attraction of crypto is more about decentralization and less about lawlessness. That's, again, part of our reputational challenge. For me, what we're building here is a financial system away from central gatekeepers. That's really what it's all about. We're building the internet. People who think what we're trying to do is build secret magic internet money that can't be surveilled, those guys are probably in the wrong line of work. It's that we're building decentralized financial systems that bankers don't control. That's got to be a positive.
Okay, well, let's kind of conceptualize that then, because the decentralized nature of this is obviously a big part of the appeal here. But the stability, at least when you look at other markets, the stability is often centralized in a way, or at least what brings stability is that centralization. I mean, we once had a decentralized economy here until somebody decided that, you know, we needed to create a Fed and have some sort of stability built into the Fed's mandate here. If you get to a stage here where you want a system of rules, a system of speed limits, if you will, isn't that in and of itself almost a centralization? How do you do that without re-centralizing things?
Yeah, I guess, look, you know, there are a couple of problems with that analysis. I mean, the first is we didn't create the Fed, you know, in the 19 teens because decentralization was bad. We created the Fed because we didn't have a technological ability to allow people to transact directly with each other. And so somebody needed to issue the dollars that could be accepted everywhere. But we now have technology that does that. It's sort of like, you know, the reason that the post office was the way we transacted information in the olden days was because there was no way for somebody in New York to talk to somebody in San Francisco. And then we had email, and we didn't need the post office the same way that we used to, right? So technologies sometimes supplant the assumptions on which institutions were built. So where you say stability, Romaine, I would say brittleness. Yes, it was stable. It was also super controlled, right? It was also incredibly expensive and didn't work all that well. It was merely the best thing we have. Now we have something better.
If we get to a stage where we see more rules, who should have the oversight?
Well, my personal view is it depends on the utility that we're talking about. So remember, every cryptocurrency represents a different function, right? These are all different networks being built for different things. So, you know, if you're talking about Bitcoin, which fundamentally is an investment asset, it's kind of digital gold, we like to say, it ought to be regulated if it's regulated, like investment assets are regulated. It's not a security, of course, but it's something that people buy and hold for its value retention properties. Versus Ethereum is a network for the remission of payments, right, or for crowdsourcing of funding. And so if it's like a payment mechanism, you'd expect the banking regulators to talk about that, which is what I did at the OCC. So it all depends on what the underlying activity is. Like activities should be regulated alike. They shouldn't be regulated by asset class category. If this is a payment mechanism, it ought to be regulated like a payment mechanism, et cetera. And I think that's the mind shift that regulators need to achieve here.
You spent a brief time as a regulator here. Do you think that regulators and, more importantly, some of the legislators in Washington understand those distinctions?
Well, I think that they do more than they used to. So, you know, I entered crypto about 4 years ago in sort of a big way. And at the time, the knowledge base on crypto on Capitol Hill was very, very shallow. There were maybe 2 or 3 members of Congress who really had started to explore it. But at this point, you know, we've had multiple United States senators and multiple members of the House of Representatives who really get it. And I'm talking about people on both sides of the aisle. That's the interesting thing about crypto is it's a weirdly nonpartisan issue. People who go down the rabbit hole and get the network effect of crypto really are long this, and that includes people on both sides. So I think we have a lot more of that. I think at the senior regulatory level, there are people who've just never used it. It's possible it's because they're at an age where, you know, we're comfortable enough with the status quo that exploring new tech is not a thing. But we need to, we really do, because if we lose this race to other countries, you know, if we lose control over the next internet, that's going to be bad for generations to come.
Well, part of what's going to drive the debate, that certainly in Washington, is going to be, I guess, how people sort of view the case for crypto. Is it just a speculative asset? Is it a store of value similar to gold? Or is there a use case for it as a transactional means here? What's the argument that you make?
Yeah, well, look, first of all, let me just say that the token-focused approach to this conversation, I always say, is the wrong approach. So forget about the crypto tokens for a minute. Think about the networks that are the reason the crypto tokens exist. That's all tokens are about, okay, is to induce people to participate in networks. So forget about whether, you know, Tezos or Filecoin or Uniswap are going to be more valuable tomorrow or less valuable tomorrow. The question is, do you have a thesis for the underlying thing that they're powering? So think about it this way. You don't buy Apple stock because you think that the stock is going up or down. You buy Apple stock because you think that iPhones are going to win in the market. And if they win in the market, then by definition, your stock is going to go up in value. Same thing here. If you think Ethereum is the best platform to build financial services apps, then ETH tokens are going to go up in value. Stop thinking about the sort of the technical analysis of the shape of the price movements and start focusing on the network that's being built. The networks that win will have very valuable tokens, and it's more like that than it is about the tokens themselves. So That's why at the OCC, we really focused on the idea that some of these networks are payment networks. They're being used by companies to transact value from person A to person B. So they should be regulated like SWIFT and the automated clearinghouse, right? It's very easy to understand that. Yeah. Versus other things like Filecoin, it's a decentralized storage device. It should be regulated like the cloud. Once you think about it like that, it's a very different discussion.
Are there regulations already out there that maybe the crypto space can sort of be, I guess, slid under rather than creating something completely new? Just real quickly here, Brian, I mean, there's a question from the audience basically on this point here about what incentives can regulation add compared to what we have now or what we don't have now?
Well, so that's a fantastic question, especially for right now. Okay, so one of the reasons that Bitcoin is down the last couple of days is because of people's interpretation of the Chinese government's being believed to have said we're basically banning crypto. So you could get a lot of clarity and price stability by just knowing that the US government wasn't going to ban crypto. And this was a point that I made when I was still in government, was to say nobody's going to ban Bitcoin. All right, there's a $2 trillion asset class in crypto that's not going to go away. So let's start by saying it's okay to be in the asset class. And then what somebody needs to say is if a crypto token is a security, for instance, that doesn't mean it's illegal. It just means that, like other securities, there are certain disclosures and registrations that have to be made. And we need the SEC to create a pathway for that to happen. I mean, if you think about the Ripple litigation, Romaine, people wouldn't be in a panic about it if, in the event Ripple lost, they could simply register the token and trade on a securities exchange. The problem is that hasn't been allowed yet.
To your point, though, about the idea that it won't be banned, I mean, that's a fantastic point. There is concern here that China may not ban it, but it may compete with it. The U.S. may not ban it, but it may tax it into oblivion. Was there a concern there?
Yeah, I mean, look, I think there's always a concern. But again, that's not just about crypto. So when you think about taxing things into oblivion, you know, we have an administration right now that's talking about imposing a capital gains tax higher than the income tax. That will kill the stock market. And yet again, nobody's asking if equities are going to go the way of the dodo, right? We have high tax periods of time in the country and low tax periods. Asset classes survive. Americans are highly ingenious at finding ways of creating value, and that'll happen with crypto too.
All right, another question here from the audience for you, Brian, and this has to do with how you value or how someone would go about valuing crypto, and the idea of sort of what is sort of the main indicator of inherent value in cryptocurrency other than just, I guess, hopes and dreams?
Yeah, well, so let me just begin by saying what I'm about to say isn't financial advice. I'm not advising anybody to buy or sell anything. Sure. But having said that, you know, I have a certain thesis for certain kinds of cryptocurrencies. I really believe that I'm a banker by background, and I believe that decentralized finance is the future of financial services. So if you believe that, if in the future people are going to get a better interest rate at, let's say, BlockFi than they're getting at JP Morgan, then the BlockFi token is going to be highly valuable, or the Uniswap token, or the Maker token, if you think about that. If you believe that online payments are a major innovation in the world, then you're going to believe that the USDC token is a great place to transact, or that the Solana blockchain, which allows you to transact instantaneously, is a highly valuable network. So again, it's not about guessing and speculating. You don't do that in your stock portfolio. You buy companies that are building products you know and believe in. It should be the same thing with cryptocurrencies. You have to understand the underlying network being built and have a thesis for why that network is more valuable than another one. If you can't articulate that, you're probably in the wrong asset class.
All right, you certainly understand finance and you understand regulation here. I mean, you spent some time at the OCC, the Office of the Comptroller of the Currency, here in the United States here. You were involved in writing some of the potential rules, proposed rules out there that would apply to this crypto space. As we speak right now, your successor is on Capitol Hill at a hearing basically saying that some of these rules maybe need to be rethought here. When we talk about the regulatory process here and how the regulations sort of get made here, is there sort of a process where you are confident that what ultimately comes out on the other side is actually going to be beneficial to the end investor, not necessarily just to Binance or just to some of the crypto platforms, but to the actual investor, the end user here?
Oh, for sure. I mean, look, first of all, to your point about the testimony that my successor is giving right now, I think he made a lot of good points in his written testimony that I agree with, having to do with, look, we need to make sure that all stakeholders understand what's going on here. That's the very reason I kicked off a dialogue about crypto, because I think more than the other regulators at the time understood the magnitude of crypto and how many people were participating and how big the market was. By the end of my tenure, we had all of the financial regulators coming together around a statement on stablecoins. That had never happened before. And I think having a broader interagency dialogue about the role crypto plays in the economy is a great thing. I really like his statement in his written testimony that these kinds of network changes and fintech growth generally is inevitable, I think was his word, can't be stopped. And I think that's exactly right. So different political parties will address it differently, but I think all of that is good. To your question about how do we know that this is benefiting the end user, it's going to benefit the end user in the same way that original internet apps benefited the end user. So think about it. In the first internet crash, people decided that barbecue.com and pets.com just weren't any better than going to the mall. But they also decided that Amazon was way better than going to the mall. And that's where the value got created. It's exactly the same thing in crypto. Some of these apps, some of these tokens are going to be world beaters, and some of them are going to go to zero, just like happens in the stock market. So we need to get away from the bias against crypto and understand this is the new way value is going to be created in a networked future.
All right, you're relatively new in your job as head of the Binance US here. With regards to the regulation that could be coming down the pipe here, how structured is your business, is Binance US's business right now to actually adapt to any of the regulations coming down the pipe?
Well, look,
are you prepared?
we're always going to comply with whatever the regulations are at a given moment. So just keep in mind that Binance US is already regulated by 43 states, 44 if you count our recent conditional approval in Hawaii. And we're on our way to having all 50 states licenses, which means we get examined by state regulators, much the way banks do. We participate in money services registration with the Treasury Department. So there's a regime today that we have to comply with. And in the future, we may acquire a trust company for custody businesses. We may acquire a broker-dealer once the SEC allows such things for crypto assets. There are a lot of other things we'll do. But at the end of the day, in the same way banks have to adapt, we need to comply with what our democratically elected representatives say we have to comply with. That's what it is to operate in a market democracy.
Okay, well, part of that compliance also deals with the anonymity and some of the issues that have been raised about the anonymity of people who transact in Bitcoin. Are you set up in a way where if there were greater scrutiny on that side of the business, know your customer type of rules that specifically applied to Binance US and other crypto exchanges, are you capable of actually following through on that?
Oh, for sure. I mean, look, one of the things we're going to be on the front foot on, Romain, is building crypto native technologies to comply with those kinds of rules. So just as an example, the idea that what we ought to be doing is treating crypto transfers like they're wire transfers so that we can say, oh, that's Romain sending Brian $100, which is what happens in a wire transfer. That's probably not an appropriate way of approaching crypto regulation. But what can happen in a blockchain native world is we can know that Romain is sending money to an internet address that is a good internet address, not a criminal internet address. And there are attestation models being built by a number of fintechs around the country right now that will achieve that very thing. So nobody should care that you're sending me money. They shouldn't be able to dox you for sending money to some unpopular person, but they should be able to have confidence that you're not money laundering, that you're not financing a terrorist regime or whatever. And that can be done in a way that doesn't require people's names and addresses to be identified. So I think that's a critical value add that we'll bring in the next year.
Okay, well, I mean, just to play devil's advocate here too, as well. I mean, the government also would look at this not only from a money laundering or criminal activity standpoint specifically, they would also look at it, I guess, from a financial disclosure, taxation perspective. They want to know that Romain received $100 from Brian, so that they can, take their cut out of it. So I guess my question then goes back to this idea here that if the government does decide, at least the U.S. government does decide that it wants to maybe move a little bit closer to doing that in the same way that they do now with certain bank transactions here, does the business model of Binance US stand up to that?
Yeah, I mean, look, it'll stand up in a lot of ways, in part, Romain, because we will not always have an exchange fee-based model. We'll have a lot of other products and services we bring to bear that don't even get affected by those things. But at the same time, I have to say, we as a country need to have an open dialogue about what the appropriate level of government surveillance and government control in our lives are. So I think you've correctly articulated one point of view, which is that the government wants to know every dollar that gets spent and on what. I would ask people who are watching this program to just say, what things have you bought in the last year that you'd prefer that the government not necessarily know about? And you probably paid cash for those things, right? Do we want to have a full surveillance society or not? That's just a political debate that we need to have when we think about what our values are. My personal belief is there is an appropriate level of financial privacy, which isn't zero. And I'm good with a world that says, hey, Brian, as long as you're not violating the law, you do you. I think that's kind of the ethos of crypto, and I hope that'll be where we come out as a country.
And I have to ask you about the news that was reported a little bit earlier this month about the Justice Department and the IRS looking into certain things surrounding Binance and the platform there. Is there any update that you can give us on what's going on with that investigation?
Yeah, look, I mean, I think some of these things are well known and have been for a while. You know, there was the now debunked story from last October about, a supposed plan for Binance US to funnel US customers to Binance.com to purchase, investment products that are not allowed in the US. There's not any truth to that. And believe me, I wouldn't have joined this company if my due diligence didn't make me very comfortable with that. But it's not surprising, given that level of publicity, that federal agencies are going to ask questions about that, and we're happy to cooperate in all of those things. There are issues that they're looking at us and others. And, I think people sometimes report on us because Binance.com is such a huge company and so far and away the biggest exchange in the world. But I can tell you, Binance US was established to comply with U.S. laws. That was the whole point. It was not to evade U.S. laws, but to provide services to U.S. people on a legal basis. And under my leadership, that's what we're going to do.
What's the general corporate relationship right now between Binance US and Binance based over there in China?
Yeah, I mean, it's a truly arm's length relationship. I mean, we have some licensing agreements that allow us to license their brand and to license certain of their technologies. But more and more of that technology is being insourced on the U.S. And, over the next 6 months, virtually all technology will be independently managed. So we really won't even need a lot of those licenses anymore. But, Binance U.S. was bootstrapped by a very famous crypto visionary who said, hey, I can't serve the U.S. platform on this, or on the market on this platform. I need a U.S. established, managed, and owned platform over there. And that's what I'm here to lead. So obviously, the brand is very valuable. The product licensing is very valuable. But, that's a very different thing from them owning us, which they don't.
All right, we only have a couple minutes left. And I'm going to kind of circle back here to some of the price action in Bitcoin and some of the other crypto assets. And the idea here that over the past year, the investor base for cryptocurrency has not only broadened, but it's brought in a whole new group of people, institutions, and I guess apologies to previous investors, but people who would be considered to be a little bit more legitimate in a lot of respects. We've heard from a lot of those people on the Bloomberg network this morning, basically saying that today's sell-off is kind of needed. There's a little bit of a correction needed, but the longer-term thesis about the use case for Bitcoin or the speculative aspect of Bitcoin or the store of value aspect of Bitcoin, that still remains intact here. When you look at your own customer base here, is it still primarily individual retail type traders? Or are you hearing more interest from institutions about how they can transact in this world?
Yeah, I mean, the answer is actually both. I mean, our institutional business is exploding at the moment. And in fact, the number of corporate CEOs that are calling me asking to build their own corporate tokens for loyalty purposes and all kinds of other corporate finance purposes is really amazing. So that's going to be what the future is. But our retail investor base is growing 10 or 15% a month at this point. As I say, we traded $3.3 billion on Binance US yesterday. These are enormous numbers, and that's coming just from organic retail customer growth. So we're pretty proud of that.
Any plans to go public?
Well, look, we're going to diversify our cap table this year. There's a lot of venture investor interest in this company, and I think that there will be at some point an IPO in our future. Coinbase provides a great pathway for that. But in the meantime, there's a lot of interest from U.S. investors wanting to own a piece of this company, and we'll be having announcements on that in the coming weeks.
All right, Brian, it's been a pleasure. Really appreciate you taking time to be here for our summit, the Bloomberg Businessweek Summit here. Brian Brooks, U.S. CEO for Binance.
Thank you.
Can you hear that? No? Understandable. It's been quite faint lately. Drowned out by trading and tickers, assets and interest rates, bulls and bears, by the things that have come to define it, but that have little to do with why it's so powerful. It's the beating heart of capitalism, the collective sound of the people who build and borrow, strengthen and serve, invent and ignite. And it's ready to come roaring back with our help, our know-how, our vision. Just listen. And you'll hear the sound of change. It's happening all around us. And if we stand together, we can write a new future for capitalism, where equity is elevated across the board, people are valued as much as profit, and everyone aspires to a higher bottom line.
Welcome back to Bloomberg Businessweek, and welcome to all of our viewers on Bloomberg Television and listeners on Bloomberg Radio worldwide. Joining me now is the president of the Atlanta Federal Reserve Bank, Raphael Bostic. Thank you very much for joining us today, Dr. Bostic. I'm hoping this is the last time we have to do this virtually, that we may be getting beyond this pandemic, because I know this is the time when you would be having your Atlanta Fed conference in person down at Amelia Island.
That's exactly right. Mike, it's really good to see you anyway, and I'm really looking forward to when I can actually be sitting right next to you and having this conversation.
Well, the European Central Bank said today in its financial stability review that it sees remarkable exuberance in markets these days, which obviously takes us old guys back to Alan Greenspan's irrational exuberance, and we remember what happened a few years after that. Do you see any parallels to today's markets, to today's asset prices?
Well, you know, I don't spend a lot of time worrying about asset prices, but I will say that there is a lot of drive that is driven by profits and profitability. And we saw this, we've seen this through the pandemic period. I think that the markets are speaking for themselves. There's a lot of reason to be optimistic about how the economy is going to progress. And we'll just have to see whether the bets that investors are making get borne out as we go through the next several months.
Well, the ECB went on to say that if U.S. inflation accelerates and pushes up bond yields, spillovers from U.S. equity market repricing could be substantial. Do you take into account the effects that U.S. markets could have on other economies around the world when you're considering policy?
Well, we're the U.S. central bank, so we primarily focus on the impact of our policy on the United States. But it is certainly the case that in a global economy, the effects of our policies on businesses and investors worldwide will have a feedback loop back on us. So it's something that we have to understand and appreciate as we think about our policy approaches. But it's not the primary driver. You know, for us, we have our dual mandate of maximum employment and stable prices. And that's really where I try to keep most of my focus.
I have to quickly ask you about one of the stories of the day here. Does the Fed care if Bitcoin or Ethereum or any of the other cryptocurrencies are plunging in value?
Well, you know, I think that, you know, the crypto space is one that's very exciting and interesting to watch. There's a lot of volatility in it. But right now, it's not at a scale, and it doesn't have a reach into the economy that has systemic implications for us. So at this point, it's you know, personal curiosity. I watch these markets and try to understand them, watch it on Bloomberg, for example. But it's not something that I really incorporate very much into how I think about where our policy should be.
Well, if you get FedNow, your coming instant payment system, up and running, is there going to be any need, do you think, for a Fed digital currency? I know you're, as the Fed is looking at it, but is there any cryptocurrency in the Fed's future, or are you going to be able to cover that with instantaneous day one transmission?
Well, you asked two questions here. And, you know, first I would say FedNow, which would be our instant real-time gross settlement system, I think serves a lot of the purposes that you would need look for from a digital currency. So in that regard, I think it takes us very far down the road. But as you know, there have been so many evolutionary developments in the digital currency space that we need to study this and make sure that we understand the implications of those developments for what we're doing here at the United States to determine the extent to which we actually need to have a digital currency that's issued by this central bank. You know, one of the things that's been very interesting on this is that there are lots of issues around this. You know, questions about the relationship between a central bank and the American public that we really have to sort through. And so that work needs to happen. It's going to take some time for us to get through it. And when we do, we'll take that information as well as what we're seeing globally to make a decision about where to move forward.
Let's turn to monetary policy and the economy now. We haven't had a pandemic like this ever, at least in terms of since we've had data. And in recent weeks, we've had a big downside miss on jobs, a big upside miss on inflation. And I'm wondering, as you try to figure out how the economy is going to evolve, how much trust you can have in your forecasts and your staff forecasts?
Well, you know, Mike, to start, I would just say you nailed it right on the head. We've never had an experience with a pandemic. There's not a pandemic response chapter in econ textbooks. So we're going to have to be very nimble in terms of our monitoring of the economy and our policy responses. You know, when I think about where we are right now from an economic perspective, the word that comes to my mind is transitional. Like, we've gone through this pandemic, we've seen the loss of millions of jobs, and now we're transitioning out of a pandemic space into more of a recovery space. As we've gotten that public health challenge under control with vaccines and better management of social distancing and other measures, now we can turn ahead. And so we're actually transitioning out of the depths of a pandemic into a recovery period. And it's just a lot of moving parts that we'll have to keep tabs of. What I will say, though, is that I'm expecting a lot of volatility over the next several months. They're going to see fits and starts. You mentioned that in the last several months, we've had data points that have not met up with expectations. I think that's to be expected. And what that will mean is that we're going to have to do extra work. And at our bank, we do lots of surveys of business leaders and communities. And we also do a lot of outreach to have one-on-one conversations with folks on the front lines to get a better sense of what they're seeing, and more importantly, perhaps, how they're thinking about what their strategies are going to be moving forward.
Well, let me ask you about those conversations that you have, and we'll break it into two parts. First, on employment. What are CEOs telling you in your district about whether they can find workers, whether they're having to raise pay?
So I'm definitely hearing concerns. You know, this is in the news reports all over the place that, you know, the labor market is such that a lot of firms are having problems finding people to fill the slots that they have available. Some are responding by increasing pay, and, you know, some had been thinking about increasing pay before. And this is really just an acceleration of that realization. But I think this question about what's happening in labor markets, what's happening on the employment side, is something that everyone's starting to work through. And here again, I would say the word that comes to my mind is transitional. As we are transitioning, we have policies that were designed for the pandemic, such as the unemployment insurance. That still is going to influence where markets are. But we also have ongoing concerns about just safety in the workplace. We have issues around how do we manage childcare, issues around just burnout. I've talked to a number of people and workers who have said, you know, this has been so stressful, I just need a break, I need to step back. And then others are really starting to think, well, maybe this is a time for me to retire. I've been eligible, I've enjoyed work, but you know, in a pandemic world, you know, there's a lot of self-reflection that goes on that might lead to changes. So there's just a lot going on here.
The other half of this is if they do give raises, they've got to pay for them somehow. Are companies telling you that they are not just raising prices if they are, but that they are going to continue to raise prices? In other words, an ongoing acceleration of inflation?
So this is where there is some uncertainty. So today, right now, most businesses that I talk to who say they're having to pay more for workers are telling me that they've been able to pass that through into the final price of goods on the marketplace. What they have been less clear on is whether this is going to be the new normal, so that that pace of inflation continues once we get through, say, the summertime, and the relief payments have been spent by so many families, and savings go back to a normal level. So I think this is one of the big unknowns as we move forward, and it's going to be something that I actually spend a lot of time thinking about and paying attention to get a sense of whether employers and whether firms believe that they have a different relationship with consumers and their ability to pass on price increases.
Well, I have to get to the key question kind of early here in the interview, but there's definitely going to be a staring contest between you and the markets, given the volatility and the uncertainty you're talking about as we get data points over the next couple of months. And I'm wondering, with your new framework, can the Fed resist market pressure? I'm sure you'll say yes, but the markets remember December 2018 when we had the Powell reversal.
So all I'll say is yes. My job is to look at the data as it comes in, collect as much on-the-ground intelligence as possible, and then make a judgment about where the appropriate stance of policy is. If we see that substantial, significant progress towards our goals, I'm going to be advocating for us moving policy. Now, we are not there right now, and I want to emphasize, no one should take this as an expectation that I'm advocating that we move our policies tomorrow. We're still 8 million jobs short. We have not had the sustained level of inflation above our target that we are looking for, but I'm paying attention, and because this is such an unprecedented time, I'm going to try to be as prepared as I can for whatever happens coming down the road.
Well, I guess one of the questions everybody on Wall Street trading desk wants to know is, how do you, Raphael Bostic, define the word transitory?
So, what I look for in transitory is really the notion that you have a shock to the economy, either on the supply side or the demand side. It's going to resolve itself, and it's clear that that's going to happen, and that the impacts of that shock don't have long-standing effects in terms of how businesses and how consumers view their approach to producing and buying goods. So if we have an impact and it leads to sort of some temporary or contextual changes in behavior, if that behavior then dissipates and we go back to where we were before, then we're transitory. That looks like transitory to me. If, on the other hand, we see that it leads to a rethinking by business leaders and by consumers about maybe the patterns in their approach to buying goods, then that's going to look a little more structural. But what I will tell you, and you know this undoubtedly, it's very difficult to identify structural changes in real-time data. And this is one of the reasons why I'm spending a lot of time out there talking to business leaders. My team is doing the same, so that we can try to identify those structural changes as early as possible.
Well, how long do you think it would take before you could decide whether we're going back to the way it was or we've got a new normal?
So I think this is going to vary by industry or sector. What I will say is this: I'm expecting a fair amount of volatility through the summertime. And I think businesses are going to be really evaluating their experiences as we see the stimulus payments spent down, as we see families really go through that pent-up demand period. Everyone is really looking to get out and be engaged in the economy and all that kind of stuff. Once we get that settled down, once the kids are back to school, once we start to see how families are allocating their labor and workforce, then I think we will start to get signals from business leaders about how they're thinking about their strategies. So I'm going to continue to ask as we go through the summer. I'm expecting they're going to say, well, there's a lot going on here. Hold on. But, starting in September and moving in through the fall into the winter time, I think I'll start to get some signals that will allow me to answer that question.
I'm looking forward to coming to the next Atlanta Fed Financial Markets Conference, but I'm not sure if you're going to have Larry Summers come back after yesterday's speech there. He told your conference yesterday that the Fed's new framework policy is a mistake, it's too mechanical. and you need to focus on overheating as the main risk to the economy. Can you tell me where and why you might think he's wrong?
So, I actually think that what we said in our statement is that we're going to let experience be our guide. And we're not going to be preemptive or proactive to stop things that may or may not happen. And what we've seen over the last 10 years is that, that expectation that inflation was just going to emerge didn't happen. And so policy could have a sort of an inappropriate or unintended impact on the trajectory of the economy. I don't think that the framework says that we're not worried about overheating. I think for me, when I see the framework and I looked at the words, what it told me was that we're going to look for evidence of overheating before we move definitively. And so in that regard, I don't think that Larry is saying something that different than us. I think he has his own style of communicating, which is very Larry Summers, and I'm not even going to try to replicate that. But I think people just should understand that, for me, I actually do worry about both sides of economic performance to make sure that our policy is deployed in a way that allows us to have a stable, predictable, and prosperous trajectory for growth.
Well, Alan Blinder, who served at the Fed, said today he's not entirely unsympathetic to Professor Summers because he says there is a hell of a lot of aggregate demand out there chasing less aggregate supply. Do you feel you have a good handle on both sides of that, enough to know whether overheating is taking place in time to do something about it?
So I actually do. One of the things that's been very interesting about this pandemic, and it actually was evident very early on, is that demand has responded much faster to the marketplace than supply has. And it's taken supply time to sort of catch up. And we're seeing this in a number of different ways, whether it be semiconductors or lumber response for housing, or even appliances and their availability for families that are looking to upgrade at their homes. The question is not whether there's that imbalance that happens initially, it's whether that persists over time. And as I've talked to business leaders, what they've said is that for many of these things, they're not expecting them to really last for an extended period, so that the dynamic that we're seeing now is not that new steady state dynamic. And so there's a reason to be less concerned. But I do want to emphasize again, this is why we talk to people on a repeated basis. I want to know whether their views on this are changing, because if they are changing, then that will lead me to have to rethink sort of my approach to where our policy should be.
You put in place $120 billion a month of quantitative easing, bond buying a year ago as an emergency action. Do we still need that much money? Markets are functioning. Bank lending is actually lower than it was, so it doesn't seem to be adding anything to stimulus at this point. Could we do with less than that and still have the economy on the same track it is today?
So I think that's a fair question, and it's something that I'm talking about with my team internally. Right now, I would say I've not come to a clear view on this. I do think that as we continue to move forward, we continue to see progress in the labor market, we see inflation at or above our target. This is a question that we're really going to have to sort of ground ourselves in, and I'm going to have a view on it. I will say, I've said this in the past, I've told you this, I stay open to every possible scenario. And as we see the world happen, I want to make sure that I'm ready with a view on what an adjustment should look like. So as we go through the summertime, as we start to get some of the jobs reports and see where inflation is, I'm going to really try to hone down my thinking on this and be able to articulate this to our committee in a way that hopefully is compelling and leads us to a policy shift when the time is right that accomplishes the things that we're hoping to.
Your background as an economist is in housing, and I'm wondering if you agree with the Boston Fed president, Eric Rosengren, who said the mortgage market doesn't need as much support as it's getting right now. In fact, it might be becoming a financial stability concern. Is there a case for tapering mortgage bond buying ahead of Treasury buying?
Well, I think that's something we're going to definitely have to think about. I actually don't agree with Eric to the extent that what we're seeing in mortgage markets today doesn't come close to approximating where we were at the outset of the great financial crisis, where we had a large amount of subprime lending. There was a lot of fraud in the marketplace, and there was just a lot of, we'll just say, not good behavior going on. That's not happening today, and in fact, what we're seeing is, and what I'm seeing is, home buyers eagerly trying to engage in the marketplace, home sellers far less eager to put their homes on the market, in part, I think, because we're still in this transitional period. And so there is that imbalance, and new home construction is struggling because of input costs. So I think there's some foundational issues in the housing market that can justify where we are today. My hope is that some of these supply issues get resolved, and consumers and homeowners return to their mindset as to how frequently they want to move and how willing they are to engage in the sales market.
Before we let you go, I wanted to ask a little bit about the Fed's focus on helping the poor and marginalized sectors of society. There's some concern that you'll be so focused on that you'll be late to respond to inflation. And there's other concerns that it's a hard sell to certain aspects of the American body politic because it's sort of outside your remit.
Well, to the second point, I actually think that it is very much inside our remit. I worry about economic prosperity and an economy that works for all. If we do that well, our economy will grow faster, it will be more innovative, and it'll be more resilient. So anything that's a barrier to that, I think, is something that is worthy of talking about, and letting policymakers know that we're seeing it and that they should be thinking about ways to act. I think that falls well within our purview. When we think about, is that going to become too much of a focus? I actually don't think that that's really something. That's not something I worry about very much. I think that we're going to take, and I'm going to take, as broad a perspective as possible on how labor markets are performing. And my job is to do risk management and weigh the various factors that are out there to come up with good policy. So I won't forget everybody else, but this is just going to be one more data point that I have in thinking about where we should go.
Well, thank you very much. Raphael Bostic is the president of the Atlanta Federal Reserve Bank. Thank you for joining us today on Bloomberg.
It's been a pleasure.
All right, so welcome everybody. This is Bloomberg Live, the Business Week, and I'm here with actor, humanitarian, athlete, and he's also got his own brand of whiskey. I'm talking about Sam Heughan. And of course, Sam, so great to have you here. People know you from Outlander, know you from Men in Kilts, but if you watch this series of Outlander, you guys drink a lot of whiskey in it.
That's right, yeah, we do. It's obviously, Scottish. It's our national drink, right? It's our national heritage, and we're very, very proud of it. And actually in Men in Kilts as well, we tend to drink a lot of it. But yeah, I guess that was almost a way that sort of got me into whiskey, coming back to Scotland and really falling in love with my country again.
Well, talk to us about that, because there's a lot of celebrities, I think, and I bet a lot of folks were kind of banging on your door saying, listen, we'd love for you to endorse this or put your name on this. But it sounds like, from what I read and listening to some interviews, you were really involved in this project.
Oh, absolutely, yeah. I mean, this for me is a passion project. And I know, there are celebrity brands out there, and I think it's hard to get away from that terminology or that concept. But to be honest, for me, it wasn't about that. I was approached by a lot of different brands, a lot of different distilleries to put my name to their whiskey or to white label something. But to be honest, I wanted to get it right. I wanted to do it myself. We were purely self-financed. Myself and my business partner, Alex Neruzzi, we did all the groundwork. We did the tour around Scotland. We went to every distillery. We tried everything, and we wanted to get it right. And if we knew that if we didn't get it right, we weren't going to release it. And hopefully, the proof is in the tasting.
Well, we're going to taste it shortly. Tell me, it's a blended whiskey, though, right? So why go that route?
Yeah. So, okay. So I think single malt whiskey, Scotch whiskey, is synonymous with Scotland, and there's this great great love of single malt. But for me, I think, blended whiskey has so many characteristics that are unexplored. And people kind of looked down on blended whiskey in the past, certainly in around the 70s and 80s. There was a lot of really bad blended whiskey. But then we look to Asia right now. They're making some fantastic blends that are very smooth, very easy to access. And for me, I wanted to create something that really reflected my love of Scotland, that was very Scottish, but yet still had that smooth and easy drinking accessibility that the Asian blends have. So I wanted to create a Scottish blend. And of course, there are some big blends out there, like, the Johnny, those other brands, the ones that we don't want to mention here right now. But I wanted to create my own, And it's exactly that. It's something that, I love to drink, but also people that maybe have never tried Scotch before can try.
What was the process like, though, for you, right? Because I think you spent like around a year and a half or so. Did you try a lot? You talk about the Asian influence and the Asian blends that you really liked. What was the process like?
Yeah, so it really did start off with a bit of a road tour around Scotland. We went to a number of distilleries all around the country, from up in Inverness in the Highlands of Scotland down to where I'm from in the borders, to the islands as well. And I have a kind of a great experience of drinking around Scotland, because it has all these different regions. But to be honest, you don't really need to know about them. But if you do, there are basically 5 different regions in Scotland. But I wanted to create something that was close to home and really kind of almost reflected, wherever I went abroad, wherever I was, if I took a glass of this, it would take me home. And so we talked to a number of distilleries, tried to find, people that had the same ethos. And we came upon this great master distiller, Michael, who we've been working with now, and kind of went from there. We just talked about what do you like, what do you not like, and dreamt up this delicious golden liquid.
All right, so come join us, everyone, because we're going to make a cocktail, Sam and I, together. Will you walk me through it? I'm not good at this, but I trust you to walk me through.
So we get to share it. Yes. So the perfect drink, I guess, for me, to be honest, is straight up is a dram of whiskey. This is a Scottish dram, and it's normally larger than most people's pours. But we're going to make an old-fashioned because everybody loves an old-fashioned. It's really simple. It's a very, very traditional old cocktail, and really simple to make. So we're going to start with I'm going to start with a glass or a tumbler. If you're going to use a tumbler or your mixing jar, you want to have normally traditionally like half a teaspoon of sugar. I'm going to go for like quarter to a half. I like our whiskey is very sweet, so you probably don't need too much sugar, but you can add more if you like it pretty sweet. So I'm going to put that in there, or you can use a sugar cube, or even a sweetener if you use those sweeteners. You then need your bitters. Which is this. You've got your, is it patient? Yeah, I can't quite see it. You've got a bitters there. You want to pour three drops onto your sugar like this. So you want to just douse your sugar.
Got it.
Like that. I would then put a teaspoon of water in there if you have water to hand. Just to help loosen it up. I don't no idea what you're doing, but it looks good, so I'm just going to go with it. So I'm going to give that a little stir.
Okay.
If you like my bar here, it's rather ad-lib bar. Okay, so we're going to mix that up till all the granules just dissolve in the water. I'm going to add a touch more because mine isn't.
We have to add a touch more too, I think.
And once. Yeah, you don't want granules. It's not doing very well. There we go. I'm now getting better. So, easy part. That's basically it, right? You're then going to add your whiskey, a good blended whiskey, which is actually, we now just found out today, we've won our 3rd double gold medal at San Francisco Spirit Awards. So,
congratulations.
Their prices.
Congratulations.
Thank you. Thank you. I'm very proud. So I would say, well, you guys are American. We do I'm going to do 50 mil. I don't know what that is in American terms, ounces. I'm going to say that's a pretty hefty, generous pour. Then I'm going to add some ice, some good ice.
My team is saying keep pouring. My team is saying keep pouring more in.
Keep going. Keep going. I'm going to do about that. Oh, you've got a good amount. Yeah, you've got enough there for the whole team. Going to give it a good stir. I'm going to see like 20. 20. 1, 2, 3. So literally, that is it. Apart
a great bottle, by the way. The bottle is gorgeous.
Thank you. We actually won some awards for that as well. But so traditionally, you can use orange peel, you can use lemon. People sometimes put a cherry. They put all kinds of fruit in there. You can do what you like, but you want to give it a twist. So I'm going to do that here. You can't quite see. I'm going to give it a little twist over the top so you get some of the oils from the orange. You might want to then rub it just around the rim. Dip it in there. If you give it a good smell, you should hopefully smell orange, obviously from the peel, but actually we've got a lot of orange and sort of citrus, spicy notes in the whiskey anyway. And then to taste, cheers, Slanjavar, as we say in Scotland.
Where do you want to go with this? You seem involved in a lot of things. You're a humanitarian. You're into wellness and fitness. Are there other things you want to do, though, in the spirits world?
Yeah, absolutely. Our tag name is Unique Spirits. And for me, this is Unique Spirit. We've won, a lot of awards. I'm extremely proud of it. We have another big release coming up in the US, North America, in August. But, we've already released a line of clothing that goes with it. We've done our own tweed and our tartan. But we're actually looking at some other spirits as well that are going to be equally unique and universally sort of accepted and accessible. So, yeah, watch this space. I'm really excited.
Got a toast for the world?
Oh, yes. Your health, your happiness, and hopefully we'll see you all next year in person. Cheers. And get your hands on this. It's pretty good stuff.
All right. Well, that was certainly a lot of fun. I'm thinking we all could use a dram or two or three after this past year, Joel.
You had a picture there. I noticed.
I did share with the crew.
Yeah,
I promise.
I'm sure you did.
Let's talk about this day.
What a day.
So much going on.
Finance, obviously, something near and dear to us at Bloomberg, and it seemed like the timing was just impeccable. A lot of interesting stuff, and great job on your interview with Cathie earlier.
Thank you very much. I really think about, Bitcoin. We came in, we woke up this morning, we saw Bitcoin and the crypto market falling apart. She still thinks we could see $500,000 on Bitcoin, staying to her conviction on her investment thesis.
Yeah, that's definitely one of the highlights of the day. What was your favorite part, other than your own interview?
What did I love? I loved everything. I loved A-Rod, but I have to say, making a cocktail with Sam Heughan.
A little bit of a crush there, don't you? It's okay.
I have a little bit of a crush. So does everybody else in our crew. But listen, there's so many celebrities coming out with alcohol. It was fun to make a drink with them.
Yeah, that's right.
Your favorite point?
I thought your interview with Cathie was great. That definitely, I was watching it very closely. I wanted to hear everything she had to say. So well done and thank you. Also, just have to say though, the issue is now live. All the great how-to content in the magazine is up. Go to businessweek.com. We've got tons of great stuff. Like I said, like 50 plus as told to. So all of these experts that we went to, curated, they will help you be an expert on anything that you're interested in, whether it's making cocktails, chicken parms, taking better investment advice,
quant strategy,
maybe making Hollywood blockbuster sequels. And I also just want to point out, I have a favorite little Easter egg that, once you get the issue in print, if you're a subscriber, that'll be coming to you this week. If you're not a subscriber yet, just a reminder to subscribe. There's this comic that I just think is fabulous, and it's a spread in the issue. One side,
the magazine's known for doing comics,
right? And it is just like near and dear to me and the rest of the staff. When we do these, we take a lot of pride in them. How to re-enter society is one side, and just like zoom in there, you can see we have naked mole rats are our characters here, and I just love this moment where one reaches over and touches the other one. That's like, it's so where we're at right now, just like, hey, it's gonna be okay, we'll get through this. and then on the other side, just because maybe social interaction still causes a little anxiety for you, it's okay to take a deep breath when you're having those social interactions with people. Remember that you can take a break, put down a picnic blanket, leave everybody alone, go have some alone time. It's okay.
It's really where we are, right? We're trying to figure it out.
I'm struggling. I'm rusty. I'm tripping over my own interactions with people, but that's okay. That's all normal. So please enjoy all that great content, both online and in the magazine.
I have to say, what's always fun about Businessweek magazine is, yes, there's the magazine like you have in your hand. There's online content. It's on the Bloomberg, but the online content online content is often like interactive. You can play around, and that's true.
Yeah, we took a lot of pride in how we put all of this together so that it's deeply immersive and tons of great voices, many of which you haven't even heard of during the week, and we've got more to come.
Yeah, we're not done yet, everyone. So first of all, we don't necessarily have whiskey. Who was in charge of?
Well, it's a little early still, but you know, this is a vessel that can be filled with liquid throughout the day and maybe later in the day. So,
and the issue's done.
We're shipping it as we speak. So cheers to that. Cheers to you.
All right.
Thank you very much.
You're very welcome. And thanks to everybody who participated. Cheers to the how-to issue, because it is out there. Check it out. It's on newsstands. It is online at Bloomberg.com. And of course, it's on the Bloomberg terminal. Thanks again, too, for everyone who's been joining us. Again, day 3 just wrapping up of the Business Week. We really appreciate it. Thank you so much. And we do want to thank also our sponsors, because we couldn't do it without them. Specifically, our solution sponsor, that of course is Deloitte. Our presenting sponsor is InterSystems, and then our supporting sponsor, which is Indiana Economic Development Corporation. You all together have made this virtual event possible. And if you'd like more information from our sponsors, please visit the resources tab on your screen.
And most of all, thank you for being such an engaged audience. The hashtag is #TheBusinessWeek. Please engage with us. We'd love to hear from you.
We love the back and forth. We're going to be back tomorrow, Thursday. We're going to be focused on politics and policy. Thanks again for watching. I hope you'll join us tomorrow at 10 a.m. Eastern. And I think Jill and I, coffee?
One more. Yeah, why not?
The issue's done.
Thank you.
All right. Cheers, everybody. Have a great day.